5 forex strategies actually work. But the strategy is the boring part. Risk math decides who survives.
5 forex strategies have survived decades of real markets. Trend following, breakout, range mean reversion, news scalping, carry. Every profitable retail system you'll ever see is a variant of one of these. But here's the part most strategy lists won't acknowledge. Your choice between them matters far less than what comes before it. 5 losing trades at 5% risk each, you're down 23%. The same 5 losses at 1%, down 5. Same trades, same outcome, wildly different account. That gap is the single biggest predictor of which retail traders survive their first year, and it has nothing to do with which strategy they picked. Before any strategy detail, lock in this hierarchy. Risk per trade, position sizing, strategy, indicators. In that order. A mediocre strategy with 1% risk and a 2-to-1 reward to risk ratio is profitable over time. A brilliant strategy with 5% risk and inconsistent sizing will eventually destroy the account on a normal losing streak. The mechanism is compounding math. Every loss shrinks the equity that funds the next position. 5 losses at 5% doesn't subtract 25%, it compounds down to negative 23. A 30% drawdown needs a 43% recovery just to get back to flat. That's why ESMA's data lands where it does. 74 to 89% of retail CFD accounts lose money across regulated EU brokers, across every strategy. The losers aren't picking bad strategies, they're over-leveraging perfectly good ones. Now, the 5 strategies. Each exploits a different structural feature of how currencies actually move, which is why one works when the others die. Trend following first. Currencies trend in multi-week swings driven by central bank rate cycles, terms of trade shifts, and capital flows. Out of $7.5 trillion in daily FX turnover, the directional slice creates trends measurable on the 4-hour and daily charts. The canonical setup, 2050 EMA crossover on the 4-hour, filtered by the 200 EMA on the daily. Stop, 1.5 ATR below the last swing low. Win rate, 35 to 45%. Reward to risk, 2 to 3 to 1. Works cleanly on Euro US dollar, US dollar YAPNY, GBP US dollar, AUD US dollar. The catch: 5 to 8 consecutive losers during low volatility chop are normal. Most traders abandon the system at exactly the point the next trending phase pays for it. Breakout. Compressed volatility resolves into directional moves. The donchian 20-day high-low system, popularized by the turtle traders in the 80s, is one of the most out-of-sample tested systems anywhere. Entry on a 20-day high break, stop at the 10-day low, filter only in the direction of the 100-day moving average. Win rate, 30 to 40%. Reward to risk, 3 to 5 to 1. The mechanism. When volatility coils, a release follows. The failure mode? False breakouts on the Asian session, when liquidity's thin and noise dominates. Stick to London Open or post-news breaks. Range mean reversion. When no fresh information arrives, pairs oscillate inside identifiable channels. Euro US dollar during Asian hours, textbook case. Euro shrank and Euro GBP historically range better than dollar majors. RSI 14. Buy below 30 in the lower third of the range, sell above 70 in the upper. Win rate jumps to 60 or 70%, but the trade-off is brutal. Reward to risk drops to roughly 1 to 1. And when the range finally breaks, and it always eventually breaks, one loss dwarfs a month of wins. Mandatory rule: 1-hour candle closes outside the range, all positions exit, no exceptions. News scalping and carry are where most retail accounts die. News scalping fades the initial spike after high-impact releases. NFP, CPI, FOMC. The order flow imbalance is real. Skilled scalpers harvest it. But execution is everything. Most retail accounts experience 20 to 80 pip slippage during NFP. The CFTC's investor alert is explicit. The price you see is not always the price you get. Without true ECN execution, the spread alone swallows the entire expected edge. Carry pays you to hold the higher yielding currency. Long AUD against short JPY at 4 to 7% annualized. Free money. Until it isn't. In 2024, the Bank of Japan exited negative rates. AUD JPY dropped 12% in 3 weeks. Anyone on 5-to-1 leverage was wiped out instantly. Carry is positive expectancy until a regime shift inverts it overnight. In 2026, the live carry pairs are USD MXN, USD ZAR, NZLD JPY, GBP JPY. None are set and forget. Monitor central bank guidance weekly or be the next AUD JPY casualty. That's the menu. Now the part that decides whether any of it actually works for you. What you pay. A half pip edge per trade on Euro USD is the entire profit margin of most short time frame systems. On a standard account, spreads run 1 to 1.5 pips. The edge is gone before you click buy. On an ECN account, 0 to 0.3 pips plus $3 commission per side per 100,000 lot. It survives. Spread is the visible cost. Swap is the silent one. Long side and short side rates differ by 3 to 6 pips per day on a 100K lot. Hold for 3 weeks, that compounds into the trade's entire expected R multiple, and slippage destroys the rest. Strategy edge dies in execution costs more often than in bad signals. So how do you actually choose? 3 filters: time, money, temperament. Time first. 30 minutes a day? You can't scalp. You need a 4-hour swing system or a daily carry overlay that triggers once or twice a week. Money. Below $5,000 on a standard account, high-frequency strategies are negative expectancy from day one. The spread eats the math. Trade lower-frequency systems and accept the constraint. Temperament. The one nobody honestly tests themselves on. Can you take 6 consecutive losers without deviating from rules? Trend and breakout will hand you exactly that. Range trading feels easier. 60% hit rate, frequent small wins, but the rare regime break wipes out a month of profit in one candle. The mechanism flips the moment the structural condition behind the strategy changes. Pick once. Trade it for 12 months without modification. Don't evaluate before then. Strategy hopping every month is the second largest cause of retail blowup. The first, obviously, is over-leverage. So what does a working retail system actually look like? $10,000 account, 20/50 EMA crossover on Euro USD, 1% risk per trade. Step 1. Check the daily chart. Price above the 200 EMA, long only. Below, short only. Step 2. Wait for the H4 crossover in the filter direction. Step 3. Size off the stop. 1% account risk divided by stop distance. Step 4. Trail at 2 times ATR or exit on the opposite crossover. No discretionary overrides. Result over 12 months, 78 trades. 31 winners, 47 losers, 40% hit rate. Net plus 8.8 R multiples. At 1% per trade, that's plus 8.8% annual return. After spread and swap, 6 to 7% net. That's it. Single-digit annual returns with realistic drawdowns of 8 to 15%. If anyone promises you 5% a month, walk away. The math does not exist. Holy Grail indicator stacks, martingale grids, rented copy trade signals, every shortcut you'll see online is mathematically guaranteed to underperform the boring 1% system over a full cycle. And remember the gap from the start, 1% versus 5% per trade. Same strategy, same 5 losses. Down 5 or down 23. The strategy is the boring part. The risk math is what decides whether you sit in the 75% who lose money or the 25% who survive long enough to actually compound.
Pick one strategy, risk 1%, trade it 12 months. Full breakdown linked in the description.